Hello, everybody. Ed Yardeni here. It's April 27th, 11 a.m. Eastern Standard Time. And are we having fun or what? Weather-wise, it's been beautiful, sunny days here almost every day. We had some rain the other day, and grass could use it. But it's been chilly, so we're waiting for things to warm up a little bit. Mother's Day is coming, and all kinds of other Father's Day, and spring is coming, and then summer, and then fall and winter. Anyways, that covers the year. This year is every year seems to be going by faster and faster, and here we are already in April. Before you know it, it'll be May 1st. Before you know it, the market may be making more new highs. It's been quite a ride that we've had in this market for a while here. In some ways, it's somewhat reminiscent of last year. Last year, we had the market started out okay, but then President Trump started talking about Liberation Day tariffs, and then I guess he actually imposed them on April 2nd. Market didn't like it. Stock and bond market didn't like it, and Trump got the message. So we had a pretty significant sell-off on Liberation Day through April 8th, and then April 9th, President kind of backed off and postponed some of these Liberation Day tariffs, and then we just didn't look back. It was just kind of almost straight up through the beginning of this year through January 27th. Now, actually, maybe just as important a date was at the end of October last year. Michael Burry started to feed the anxieties about the uncertainties with regard to the AI trade, and that made the top for a lot of the Magnificent Seven, the hyperscalers, the AI trade. But he had a good call, but it was the trade. It wasn't the big short that maybe he and others were anticipating, because here we are, and the market made an all-time high on January 27th. We had further declines in the hyperscalers and the broader market once the war got going in late February, and then we got into March, and the market really took a dive. But it turned out not to be a correction after all. It was a 9.1% decline from the January 27th top down to the I think March 30th. It was Saturday, March 30th. No, yeah, March 30th low. That was a Monday, actually. And then March 31st, the market rebounded dramatically. And so far, we really haven't looked back. It's kind of a devil-may-care attitude. The market, I think we all know that, and we've been promoting the idea that geopolitical crises are great buying opportunities. And I guess because we all know it, these geopolitical buying opportunities don't last very long. You got to be pretty nimble and pretty quick, and you got to be able to look through the fog of war. And we got kind of fogged up for a while there, but fortunately we came to we got some visibility at the end of the day on March 31st. That's when the market had a good day following the correction through March 30th, and we concluded that perhaps that was the low. And so far, so good. We think that was the low for the year. We don't think we're going to test it again, and we think we could get more volatility here, but kind of sideways action, kind of north of 7,000. But we're still looking at 7,700 by the end of the year, and that may actually turn out to be too low. We'll see. What's really just remarkable is the earnings story. We've had a very bullish earnings story, but not bullish enough. Analysts continue to get more revved up about the outlook for earnings this year and next year. And not only that, but for the 4 quarters of this year, it's up and away. They keep revising upwards their numbers. So the earnings story has been absolutely remarkable. And so this pullback that we had in the market from January 27th to March 30th, I think that was something in the neighborhood. Yeah, I know it was 9.1%. And I'm kind of, this is where I'm getting a little fuzzy on the numbers, but I think it's pretty close. I think we'd had just an outright correction in the PE. The PE came down about 16, but then the earnings numbers just kept going up by about seven. So all in all, we got a 9% drop in the stock market, but it could have been much worse if earnings expectations had been flat. Then we could have had a 16% drop, but that was not the case. I think somewhere right around the end of March, beginning of April, investors started to kind of look at the charts we were presenting on earnings and valuations and in pointing out that the valuation drop wasn't all because of the a drop in the S&P 500 stock price index, but uh, it was a valuation drop. So the stocks were cheaper and earnings were an all-time record high. And so talk about buying on the dip. I mean, there was a dip in the PEs, but the earnings certainly didn't dip, and they continue to move higher and higher. And that's the latest data we have to date. Let's look at some of these issues with charts. It's always good to support the story with the data. And so all I got to do is find the little share button, and then what? I don't know why I'm always having issues here because there's a lot of, oh, there it is. Okay, so let's start out actually usually we start out with the market call from Sunday, but on Saturday Toby and I Toby Hurst is one of our new ads. Elias has also been a new ad for us, Grip and Trupp. And here you can see we Toby and I did a thing on creative destruction on speed, and the idea is pretty straightforward. Schumpeter, Joseph Schumpeter, many years ago, came up with the idea of capitalism being a process of creative destruction, and that the idea is that entrepreneurs are always coming up with how to make better products and services cheaper, uh, available to consumers, both in business and in the consumption sector. And by doing that, they're destroying businesses that had been doing quite well. But at the end of the day, it benefits the consumer, which is really what capitalism is all about. It's not about maximizing the wealth of stockholders. It's not about uh, politics. It's all about the consumer. It's about maximizing the standard of living of consumers, and that's what capitalism does so well. The problem along the way is it does destroy industries, it does destroy jobs, and that creates a lot of political backlash. And sometimes that political backlash gets the government's attention. The government comes in and regulates the industry and makes it a little less free market. But all in all, you have to say the U.S. economy is still very much a capitalist economy, especially in the technology area. You can't really imagine a industry that does creative destruction more than the tech industry. Hence the idea of the creative destruction on speed for this particular industry. And here, remember, it wasn't too long ago that everybody was worrying that the market cap of the information technology and communication sectors was much bigger than the earnings share, and they were kind of comparing it to what was happening here when we had this big gap between the earnings share and the market cap share of these two sectors. And sure enough, we had a significant long-term correction in both of them. But really, since the pandemic, we've seen that the market cap share of these two sectors has continued to move on to match what we had back here and actually exceeded a bit. And then on the other hand, the good news is the earnings share has been supporting all that. Now, I would be delighted to tell you that as a result, we should all just be overweight technology and communication services. The only problem with that is it's already pretty overweighted relative to its impact in the economy. So I think you're pretty much fully exposed to the sector if you just kind of maintain a market capitalization weight, which is currently around 45%. Um, Now, let's look at, I mean, I guess this thing could just keep going on and on, but it's at some point, it's all these technological innovations have to create quite a bit of profitability for their customers. Right now, they seem to be uh, each other's best customers. Um, but that's another issue for another day. And so far, Michael Burry, as I said, had that issue, and it worked out for a short period of time, but not for very long. Here's an interesting chart that shows the information technology sector, just focusing on that, S&P 500 and the percent change through April 24th. And David and I came up with this chart. I think it's pretty useful. It shows year to date is the dark blue and the light blue is the week to date, just so you can kind of see the latest progress. But you can see that the market's become very bifurcated, as Toby and I pointed out. Semiconductors, hardware is doing very well. Semiconductors, however, information uh, uh, services and software not so well as you can see here. So here the hardware is all positive year to date. The software and services are all negative. This may very well continue. This is creative destruction. These companies are kind of creating the infrastructure that can run AI, and then AI is kind of eating its young, as you can see here. It's at what it's doing in the software industry. Um, I think as long as there's uncertainties about what AI can do, and AI apparently can does coding almost better than anything else, then it raises a question for these other companies. Meanwhile, in a macro sense, information technology is at an all-time record high relative to GDP. As you can see, it accounts for 53.8% of the economy. So maybe that does, not of the economy, of capital spending. So it does kind of justify this, or it certainly explains why the earnings share has been so great, because so much money of capital spending is going on technology. And this understates, this is high-tech equipment, software, and R&D by businesses. It does not include all the technology spending that people are spending at home and computers and related products. It does not include a machine tool. A machine tool these days is, I think, IT hardware combined with IT software, but that's not included in these kind of things. I mean, trucks have basically become devices that are run by logistics software. Let's go on here. We did some investigating of forward earnings growth rates, and you can see that the overall forward earnings growth on a year-over-year basis is really picking up. This is a pretty good indicator, by the way, of overall economic activity. It has been in the past. So it's certainly suggesting that things are picking up. And I know these are hard to read, but you can kind of look at the legend box here to see what actually is going on with the growth rates. Information technology forward earnings up 55%. So obviously leading the way for the S&P 500, and then energy. But these are also positive. So the notion that it's all technology and energy is just not correct. This is the same thing with revenues. As this is profit margins. You can see that tech is leading the way with record profit margins. But other sectors, if you look carefully at it and look at the legend box, you see that profit margins are expanding in other areas. We wouldn't want to see profit margins expanding just in tech, because that would suggest that whatever they're innovating here is not uh, having much impact. It's not trickling down to other industries, and I think it is. This is a wonderful chart. It shows what we looked at before was technology and communication services, as a market cap share. This is a market cap share of technology, semiconductors share of information technology. And you can see that the semiconductors are sort of gobbling up the market share of technology. It's now 41.9%. So we're up here. And it wasn't very long ago where it was like below 20%. So it's been just a rocket ship ride. And I think those of us who've been doing this for a while always get a little bit nervous when we see something going straight up, at least in terms of a market price. But if at the same time the earnings fundamentals are going straight up, well, that kind of supports the story. You can skip this. You can look at it on your own. This is just software, application software. And so investors have decided that this is not a sure thing anymore. And on the other hand, semiconductors are a sure thing. The only thing that I can think that could really upset all this is if China decides to invade Taiwan. But we don't have to go there today. We can go there another day. Devil May Care. This Devil Mountain is not quite sure where it is. I should have looked it up. Maybe some of you know where Devil Mountain is. Let me know. But it also appeared in a Spielberg movie. And again, I forget that. Let me know. Um, but here's some fun charts. This is S&P 500 sectors, percent change from percent difference from 200-day moving average. It's kind of a overbought, oversold concept. Energy, again, this is through April 24th. This is as of April 24th, and this is what the overbought, oversold indexes looked like in January. Let's just focus on the dark blue, and the dark blue shows that energy and information technology are relatively oversold, and the rest is different. It's kind of a more balanced story. But the idea there seems to be that it's confirming that a lot of investors may be taking sort of a barbell approach to the market, saying, well, things really go wrong in the Middle East. It's not like they've been going right, but at least we have a ceasefire right now. We have a status quo apparently, and who knows how long it'll last. But it's the status quo seems to be something that the White House is getting comfortable with, blockading Iranian ships and the Iranians blockading the Strait. At some point, we're going to run out of reserves that have been released by the uh, countries who've had reserves, and that could be another 30 days, and maybe that'll start putting upward pressure on oil prices. But right now, I think the markets are pretty amazed that the price of oil hasn't gone up. Uh, that it hasn't gone up more, that it's more kind of sticking around 100 than going to 150 or 200. And that may be because a lot of oil is leaking out one way or the other, but certainly not through the Strait. Um, okay, this is usually where we start out our discussions on Monday mornings, looking at analyst consensus earnings. Devil's Tower is in Wyoming. Thank you for that. Okay, have to get there. And what was the name of the movie, the Spielberg movie? Let me know if you got that one. Close Encounters of the something kind, of the third kind or so. Okay, so here we go. Look at this. This is just absolutely amazing. Through thick and thin, no matter what you think of the economy, no matter what you think of the geopolitics, the analysts keep raising their numbers for 2026. They keep raising their numbers for 2027. Forward earnings, all-time record high. Truly remarkable. Just as remarkable as usually when you get into an earnings season, you see that the analysts before the earnings season continue to cut their estimates. They did a little bit here, but then they said, well, maybe not so bad. And now they're actually, well, the numbers are actually coming in now. And so you can see that the Q1 is coming in at 13.4%. Usually we get an earnings hook. It's hard to see how you get a hook when they weren't all that pessimistic, but maybe we'll get that. Maybe it'll be more like 15%. Won't be surprised. Uh, I am surprised by how they just keep getting more and more optimistic about the rest of the year. And you can see double digits all the way across. So if you're looking for, reasons to be pessimistic, you're not going to find it in these earnings charts. I'll tell you that. Okay. Then Joe Abbott put together this useful chart for us. I think it's pretty handy dandy, showing the basically the breadth of earnings, the percent of S&P 500 companies with positive 12-month percent changes in forward revenues and forward earnings. And you can see that's kind of starting to look pretty normal here. It was pretty abnormal during this period here. But it's looking like it's going to go back up to about 90%, which is consistent with an economy that's doing just fine and consistent with a bull market. Um, we're also getting breadth in mid caps versus large caps. This is the forward earnings of the S&P 500 versus the mid caps and the small caps. And you can see that for some unknown reason, I haven't quite figured out yet why, we kind of stalled out here, but it looks like things are starting to pick up on the earnings front. And the stocks have obviously been anticipating that. So we had a valuation correction. This is the S&P 500 valuation correction. This is the Magnificent Seven correction from about 32 forward PE down to 24. That's pretty significant. And right around here, investors started to conclude maybe it's time to buy on the dip. And that's the way it's been. Forward earnings is one of our favorite economic indicators. It shows the year-over-year percent change in forward earnings versus real GDP. Not a perfect correlation, but it's certainly right now suggesting that things are getting better, not worse, when it comes to overall economic activity. And then for those of you worrying about the credit markets, the private credit issue, we will continue to update this chart showing that the regulated credit markets, the banks, are actually increasing the rate at which they are making loans. So that's something to take heart at. Now, the morning briefing today is called the oil shock and inflation. This Elias and I put together, and it reviews some of the issues that we've been discussing along the way here. Oh, by the way, Eva, if you're out there, thanks for the ID. We now on both quick takes and on morning briefings have an audio
shock and inflation. Why hasn't the price of Brent crude oil gone through the roof, despite the closure of the...
Okay, I don't know why, but I decided to have a female Australian voice on there. I just find that a very pleasant way to listen. So let me let me know what you think. But we now have, so now if you're driving to work or wherever you're driving, you can just go on the website, find the quick takes or the morning briefing, and just press on the play button and listen away. Um, and then, of course, at the top here, we have the PDF version and then the chart collection. And in the chart collection, we kind of reviewed some of the relevant charts here. One of the interesting stories here that we covered is we had these big spikes back in the 70s when in the price of oil when we had embargoes and Iranian revolutions, which was this one, and the prices went up dramatically. This is ratio scale, and on a relative basis, this is not hasn't been such a big deal. All in all, I mean, $100 obviously is more taxing, literally, than 60, $70 oil. Maybe not that much for the U.S., but certainly for other countries. But all in all, it's given that the Strait of Hormuz is closed, it's interesting to see that we didn't go up to 150 to 200. Maybe that's still ahead of us when we run out of some of these reserves that have been released from the strategic inventories. But right now, it looks as though with these commodities, or is leaking out one way or the other. We know how, and we discussed that in the morning briefing. There's a pipeline from Saudi Arabia to the Red Sea, and there's other ways. I guess I wouldn't be surprised if soon we'll be seeing videos of just long lines of tanker trucks going from the Middle East up to Turkey or somewhere else. Okay. Then we've discussed this before. The U.S. Is more energy efficient. We require less energy to produce a dollar of real GDP. I think a lot of other countries are similar, maybe not so much Europe in some of these other areas that focused on alternative energies that haven't worked out so well for them. Meanwhile, the futures markets continue to predict that this too shall end, at some point within the next 3 to 6 to 12 months, we will see lower oil prices. And I presume the market's anticipating that one way or the other, oil will come through. When you looked at the rig count is yet to show any signs that it's getting stimulated by higher oil prices, and maybe it won't. Meanwhile, U.S. Crude oil field production all-time record high. And by the way, we previously pointed out this is not the only source of crude oil coming out of the United States. There's also something called liquefied liquids coming out of refining that are essentially crude oil. And that is about 10 million barrels per day. So the U.S. actually accounts for 23 million barrels per day in crude oil production between what's in the fields and what comes out of as a byproduct out of some of the refinery processes. What are the impacts are going to be on inflation of higher oil prices? Um, I think we can compare it to what happened back in 2022, and in 2022 we had this big spike in inflation because of not just the energy shock when Russia invaded Ukraine, but also because of supply chain disruptions. This time, the supply chain disruptions aren't uh, as serious an issue. Maybe they'll turn out to be with fertilizer, but we'll see. There's everybody's scrambling, and the one thing that's marvelous about commodity markets is they are auction markets. They are very sensitive to supply and demand, and when the price goes up, you get some demand destruction, and you also get uh, people in the industry scrambling around to figure out how to increase the supply, and more often than not, they do that. So the supply chain disruptions is probably not really comparable. Meanwhile, rent inflation is coming down. That should be helpful. We did see durable goods inflation going up on Trump's tariffs last year, and that's probably going to be moderating. So we looked at some of that. This is, I mean, food could be a problem up ahead here. Um, but what did I want to show you? I think I wanted to show you this. Oh yeah. Okay. Wage growth seems to be relatively calm. I don't know that labor markets are in the comparable situation they were during the pandemic. So we're probably not going to get the kind of wage push on prices that we did back in 2020, following the pandemic. And uh, and then here's the rent story that you can look at. Well, I got a couple of minutes to answer a couple of questions. Let's see where we are. And okay, so let's see. Everybody answered my question on Devil Tower. Thank you. I have actually one question. Um, do you agree with Warsh that AI tech will lead to strong non-inflationary growth and that the Fed should not tighten into a pickup in growth and misread it as inflationary? Actually, Warsh agrees with us. We've been talking about that kind of story since the beginning of the decade. It's kind of the central thesis of the Roaring 2020s theme. It's our base case. We're not telling you nothing bad can happen, but we are focusing on the base case. And the base case we've held pretty steady at 60% is the most likely scenario. Why aren't we even more optimistic? Well, we've been talking about 20% as a scenario for a melt up. So 20 plus 60 gets you a pretty bullish scenario of 80%. And then 20% for things that can go wrong. During March, we flinched and said, well, things could go wrong more than 20%, and we raised that to 35%. Let me just turn let me just turn that off. Um, So that's it. That's so that yeah, we agree with Workforce agrees with us, and everybody's happy. But actually, there is obviously a difference. Warsh thinks that we should be lowering interest rates because he thinks that productivity lowers the real interest rate, and we have a different view of things. We think that productivity boosts economic growth. If it boosts economic growth and keeps the unemployment rate right around here, then we are in nirvana. We don't need lower interest rates. But the question is, but why not lower interest rates? Why not get even more growth? And the answer is, well, you might not get more growth if you provide even more liquidity to an economy that's doing well. You you might get I have to remember to turn off these phones. Maybe just pull out the wires. But you might get uh, more speculative excesses in that kind of scenario. So we think we're at nirvana. We think productivity growth is picking up. It's roughly around 2% right now, which is the historical average. It had been below that, and we think that it's going to go up to 2.5, 3.5% between now and the end of the decade. And every increase, percentage point increase in productivity goes straight into real GDP. It goes straight into reducing unit labor costs, which lowers inflation. It wages go up faster than prices, so you get real wage gain, and you get profit margins going up. So it brings tears to my eyes. You can't get a prettier picture than that. And I still get people coming back to me say, "Well, Roaring 2020s, that ended well." Obviously, being sarcastic, and we're talking about the Roaring 2030s. We don't think we're going to have a Great Depression because we don't think we're going to have the Smoot-Hawley tariff all over again. And we had a mini version of that last year, and here we are with real GDP at an all-time record high, stock market at an all-time record high. So we get right now we're getting all the good aspects of the 1920s, and without things kind of falling apart. And you can come back and say, well, how about private credit? And I'll come back to you with that bank loan chart and show you that there's no credit crunch out there. And you can come back to me and say, well, how about all this government debt? Aren't we going to have a debt crisis? And I'll come back to you and say, I've been doing this for over 45 years. And during those years, I've been collecting books on my shelf back there titled The Debt Bomb, Living Beyond Our Means, all kinds of doom and gloom books since the 1980s. And so far, things haven't fallen apart. Maybe they will. I've said it before, I'll say it again. When the bond vigilantes care about the government deficit and the debt, I'll care about it. And I did care about it in 2023 when the bond yield went from 4 to 5%. But then things calmed down as Janet Yellen came in and said, "Okay, I'll just issue more Treasury bills rather than bonds." So there's a lot of moving parts in the bond market, and right now, I guess one of the most amazing stories in the financial markets is just how sleepy and calm the bond market has been through thick and thin. Somebody keeps buying these bonds, and it's foreigners, it's maybe uh, companies that are issuing stable coins and have to back them up with T-bills. It's you know it's everybody are buying bonds. And by the way, I've had this kind of notion or theory that as the world becomes wealthier and wealthier, partly because stock markets keep going higher and higher, people get more and more nervous and kind of say, well, maybe I should rebalance and take some of my profits and, because they're all worried about government debt. And so where do they rebalance? They rebalance into government debt. They're buying 10-year bonds. That's kind of one explanation of why the bond yield, at least in the United States, has stayed relatively calm. As for the dollar's also stayed relatively calm for all the de-dollarization, doom and gloom stuff. We haven't been wildly bullish, but we haven't been bearish. So far so good. Anyways, I hope it's so far so good for the rest of you this week. It's going to be action-packed week, as we've pointed out in our week ahead, and we'll see you again next week. Thank you, everybody.